What's up, homies? Welcome to another episode of the Homies Real Estate Podcast. This is your host, Anthony.
I'm Angel.
I'm a realtor.
I'm a lender.
And together we're going to break down this crazy real estate market. We got another great podcast for you. I know a lot of you are looking to purchase a home, maybe your first home, and you've heard of something considered the first time home buyer's loan or the FHA loan. Well, Angel and I are going to break down this loan, how to use it to purchase a home in 2022. And thank goodness that he's a lender, because I'm going to have him answer an array of us navigate this loan. So, Angel, first things first, what is the FHA loan?
So the FHA loan, FHA stands first and foremost for Federal Housing Administration. Many people refer to it as a first-time home buyers program or first-time home buyers loan. Anthony, quick question. Is it a first-time home buyers loan?
It is not a first-time home buyers loan. You can actually use the FHA loan more than once. The thing is that you can only have one FHA loan out at a time. There are special requirements in order for you to have two out at a time. But for the sake of this conversation, let's just say you can only have one FHA loan at a time.
Exactly. Yeah. So, that's pretty much FHA again. And we'll go into detail, obviously, what FHA, what entails in an FHA loan, right? What details and all those things. But yeah, just as far as what it stands for, it's Federal Housing Administration loan. So it's a government loan or a government insured loan, right? And it's commonly said first-time home buyers loan, but it is not a first-time home buyers loan. But yeah, so we'll go into more details right now.
Yeah, and I actually pulled a fun fact. So according to FHA's 2020 annual report, more than 83% of all FHA loan originations were for borrowers purchasing their first homes. So you can see that there are some people that are purchasing using the FHA loan for second times, but again, it's predominantly first-time home buyers. Exactly. So, Angel, what is the minimum down payment for an FHA loan?
Great question. So minimum down payment is only 3.5%.
3.5% down. So for a $500,000 home, what does that look like? You know,
I believe it's either 17 or 18,500.
Yeah, 17,500.
17,500.
And then there's always closing costs, right? So aside from the minimum down payment. So what does that look like?
Yeah, so closing cost is gonna be the same across, rather if it's FHA or conventional, and that's about 2 to 2.5% of the purchase price, not loan amount, but purchase price. Usually what I notice, it's more towards 2 to 2.25%. So let's just say on a $500,000 home, you're looking at about like $12,000 in closing costs, give or take.
Yeah, more or less. So what I always like to say is, hey, account for 3.5% for the down payment, another conservative 2.5% for closing costs. That leaves you 6% of the purchase price. So once you have 6% of whatever purchase price you're looking at, whether that's 500,000 or if that's 900,000, you want to make sure that you have that set aside.
Yeah, and usually again it'll probably be a little less than that, but it's always good to think on the higher end. And at the end of the day, if you have a couple extra thousand in your pocket, it's better for you, right? So
absolutely. So Angel, what is the minimum credit score?
So the minimum credit score for FHA is 580, right? The banks that actually do FHA loans under 620, there's not many, right? So a lot of banks will not touch an FHA loan unless you have a 620, or some of them are like a 600 requirement. When COVID started, it was like, I think FHA themselves, I'm not mistaken, said we're not even doing loans under 620 right now. It has to at least be at least a 620 credit score. Now that COVID's calm down, and there's banks that do it with less than a 620, 580 to 619. The only issue with that is we need to get an approval from, it's called desktop underwriter, which basically it's a computerized automated underwriting system that we submit loans through. And it's basically saying, assuming everything your loan officer put in your loan application is correct, along with analyzing your credit report, if that is all factual, then your loan will get approved. When you're below 620, the underwriting system does get a little tougher, right? So it's doable, and interest rates are a lot higher as well when you're under 620.
Absolutely.
So I always recommend 620 because the truth of the matter is, to get from a 580 to a 620 credit score, sometimes it's not even that hard, right, to get there. So 620 is definitely what I would recommend.
Thank you. And thank you for elaborating on the difference between, 620 under and 620 higher for the interest rates, just because it definitely makes more sense when you have a 620 or higher to use the FHA loan than it does when it's under a 620 credit score. Angel, what does the debt to income ratio look like for the FHA loan?
So the FHA looks at two ratios, so debt to income ratio and housing expense ratio. We'll go over housing expense ratio first. So housing expense ratio is just based on your monthly income, how much of a monthly payment can you afford, right?
Gross income?
Gross income, correct.
Okay, before taxes.
If you are a W-2 employee, if you are a self-employed employee, we look at your net income on your business returns. But yeah, so we look at your gross income. So let's just say, to make it simple, you make $10,000 a month. 47% of, or just under 47%, we'll say 47% right now, 47% of your monthly income can be used towards a monthly mortgage payment, right? So your monthly mortgage payment cannot exceed $4,700, right? That's 47% of 10,000. Along with the housing expense ratio, we also look at the debt to income ratio, right? Which that is basically, not only are we looking at the debt from your mortgage payment, but we're also looking at all your debts. So if you have a card payment, personal loan, credit card, student loans, all that included, that cannot exceed 57%. So $5,700 of your monthly income, assuming you make $10,000 a month, cannot exceed that. Your debts cannot exceed that, right? If it does, you will no longer qualify. So you have to look. Sometimes if you have no debt at all, then we just look at your housing expense ratio, which would be the 47%, right? So that's just a brief description. It is a little complicated just to say it and to maybe comprehend it. So hopefully I explained it as best as I could in a short amount of time. But if you do have any more questions, feel free to reach out to us and we can answer that in greater detail.
Yeah, absolutely. Thank you for explaining that. So for the FHA loan, again, there's a housing expense ratio, a debt to income ratio. But all in all, you just want to keep your debt relatively low because that's going to help you qualify for more.
Exactly.
Angel, there's loan limits, right? There's conventional loan limits and then there's FHA loan limits. What do the loan limits look like for the FHA loan and what are they?
Yeah, so the FHA loan limit, what a loan limit is first and foremost is the bank cannot lend more than that, than the loan limit is set, right? So for LA County, the maximum loan limit right now is $970,800, if I'm not mistaken.
Yep.
So the bank cannot lend a penny over that, right? Any money over that loan amount has to come out of your pocket. And again, I do want to emphasize this is your amount the loan or the amount you can be lent to you, right?
Yeah.
That is not your purchase price. There's a difference. The purchase price minus down payment, that's your loan amount. So, but yeah, the maximum loan amount is $970,800. So to put it like, if you're gonna do an FHA loan, like your maximum purchase price in LA County would be $1,005,000. Yeah. After your down payment.
That's considering 3.5%.
3.5% down, correct.
So basically multiply 970 by 3.5% or whatever. Yeah. That gives you.
And then one thing I'll mention too real quick. I don't know the exacts on top of my head for the units, but also if you're buying a duplex, a triplex, or a fourplex, which you can with an FHA loan, those loan limits do increase, right? So if obviously duplexes are more expensive, so they allow you to lend more money for a duplex. Same thing for a triplex, fourplex. They increase per unit.
I actually broke down what the loan limits are, so I'm going to run it through for you just because it does vary from county to county. So in LA County, Orange County, high cost areas, you're going to have the ceiling for loan limits. But in Riverside County, San Bernardino County, the loan limits are a lot different just because they aren't high cost areas. So the loan limits do vary from as little as $420,680, as little as, what is this, Angel? Let me see. As little as $420,860 to upwards of $970,800. Because we live in the beautiful state of California, loan limits tend to be higher than that $420,000. They tend to be, $600,000+. Now, for duplex in high cost areas, that's $1,243,000. For triplex, that's $1.5 million, and then for a fourplex, $1.867 million. So you see how it increases quite a bit when you start to look at triplexes duplexes and fourplexes.
One thing I'll mention real quick,
What?
this is for LA County, right? LA County is a high cost area. Riverside, San Bernardino would not fall under that. So their loan limits are less for FHA. I think it's like, I want to say it's like 562 if I'm not mistaken for Riverside and San Bernardino County. And then Orange County is a high cost area. So it's the same thing as LA County.
Yeah, absolutely, Angel. Now let's look at let's look at mortgage insurance. See, this is a tricky topic, especially with the FHA loan. So I'm sure some of you have heard of the concept mortgage insurance or private mortgage insurance, right? And whenever you put less than 20% down, you're going to need to pay a fee, which is going to be essentially insurance in the case you default on your loan, because you tend to be a more riskier borrower. So they need to kind of offset that somehow and they usually use some sort of mortgage insurance.
Yeah.
So again, this is anytime you put less than 20% down. Now, FHA, they have a different system. They still have mortgage insurance, but it's a little bit different than the private mortgage insurance you'll see on a conventional loan. So Angel, break down what that looks like.
Yeah, so an FHA loan has mortgage insurance referred to as MIP, which is mortgage insurance premium. When we first talked about FHA in the beginning of the podcast, I explained that it is FHA insured, right? Government insured. FHA loan is a government insured loan. So this is what it means, is that they're insuring that mortgage insurance. So if you as a borrower can no longer make the payments, the government's going to pay the bank if you default on your property, right? So that is why it's government insured. But what does that mean, right? So on an FHA loan, the mortgage insurance tends to be higher than a conventional loan, right? Not a bad thing, but it is what it is. They have an upfront mortgage insurance, so that's 1.75% of the loan amount, right? Not that when you get your disclosures or when you get your documents when you're signing for your house on an FHA loan, it shows under closing costs. So closing costs look like they're higher they are higher on an FHA loan, but out of pocket you don't pay that 1.75%. That is taken from the loan amount for your upfront mortgage insurance, right? That is added on top of your loan amount, and it's financed in your monthly payment already. So you have the upfront mortgage insurance that you pay for, along with your monthly mortgage insurance that you have in your payment. In LA County, it's usually about a factor of 0.85% to 1.05% of the loan amount on a yearly basis. So they multiply that by the loan amount and divide it by 12. And that's how you get your monthly payment. I know that was a quick and fast explanation, but nevertheless, essentially what happens is that, or what tends to happen in most cases with an FHA loan, is mortgage insurance can be a little bit more pricey than a conventional loan. So I'll just leave it at that. And then, whenever you come and speak with a loan officer, they can speak in greater detail about it.
Yeah, absolutely, Angel. So I know that mortgage insurance for FHA loans is a little bit complicated. So that's why I highly recommend you reaching out to a lender, a financial professional who can break that down for you. But all in all, just know that this mortgage insurance tends to be a little bit pricier than conventional loans. And it isn't as easy to get rid of as well, which we'll go into detail about later. So, Angel, let's talk about the pros of the FHA loan. So the FHA loan is amazing, right? Because we're talking about 3.5% down, which is such a little down payment compared to, conventional 5% down, conventional 20% down, and a lot of other programs. The credit score requirement is just a 620, right? So that's pretty solid. I mean, you can go with F580, but again, me and Angel are both fans of, trying to get your credit score to 620 because the interest rate's a lot better. Angel, what are some other pros to the FHA loan?
So yeah, the low down payment we mentioned already, right? Low credit score requirement, which is phenomenal. FHA will have better interest rates than conventional, right? But some, obviously you want to get the best interest rate, but that doesn't necessarily mean it's the best loan, right? But it does have a better interest rate, so it is a pro. You sometimes can qualify for more depending on your debt, right? It might make more sense to go FHA if you have a lot of debt, but you can always run the side-by-side comparisons with your lender, see which one makes more sense. Along with really, I love, this is my number one thing for an FHA loan. The thing I love it the most for is you can purchase multi-units for as little as 3.5% down.
That's amazing. That's absolutely amazing. Because what is, like, if you wanted to purchase a duplex with a conventional loan, what are you looking
15%
at?
down.
15% down. So think about it. Like, you're able to
Huge
leverage a 3.5% down to purchase a duplex, triplex, fourplex. Like, that is.
Exactly.
That's amazing.
There are 3% down conventional programs that you can technically buy a duplex, but the issue with those programs is they have an income limit, and it's just like, it's so low in LA County where like no one qualifies for that program. It's ridiculous. I don't even know why they have it. Like, it's ridiculous, to be honest. So yeah, you pretty much have to stick to the multi for FHA if you want a low down payment. If you want to buy a multi-unit family, multi-family property with as little as down, FHA is going to be your best bet.
Yeah, absolutely, Angel. So those are really good pros there. FHA just really provides you another avenue to try to, get pre-approved for a loan, really explore both options, right? Because for most borrowers, you're going to be really looking at conventional and an FHA and seeing what makes more sense for you. If you're an investor, it might make more sense if you have a smaller down payment, just to go with the FHA loan. I mean, to be able to offset some of that payment with purchasing a duplex, especially right now with with the high cost of homes and with mortgage rates being higher.
Exactly.
That might be the move for a lot of you. So, Angel, let's talk about the cons for the FHA loan. What are some of the things that you really don't like about it that are something that the homies need to be aware of?
Yeah, so mortgage insurance, I already explained a little bit, it tends to be more expensive on a monthly basis. Along with that, you have the upfront mortgage insurance, which a conventional loan will not have. You must refinance to remove your mortgage insurance, whereas a conventional loan, you do not have to.
Wait, I want to stop you on that. So there is another way to remove mortgage insurance if you don't refinance, right? But that's waiting it out for 11 years.
I believe so.
So if you wait it out, which doesn't make sense in this market because homes are appreciating so quick that you'll get the 20% equity within 2 to 3 years typically. But let's just say you just forget about your home, right? You purchase FHA. After 11 years, the FHA will automatically fall off. So it's something to consider.
Insurance.
The mortgage insurance, I'm sorry. The mortgage insurance will automatically fall off. So something to consider as well. Angel?
The monthly payments tend to be higher. Say that you're going like 5% down conventional. Even though, again, the conventional rates are higher, right? Your monthly payment will tend to be cheaper on a conventional loan because of how less expensive the monthly mortgage insurance is, right? And then some property requirements, like with appraisal, the appraisals are a little bit more strict. Usually don't have a big issue with that, but it could be an issue for some properties, but tend to not be a big deal breaker, to be honest. And another one is sellers and listing agents prefer conventional offers over FHA.
Absolutely.
Which is very important in this market. It's unfortunate because to me as a lender, I don't really see much of a difference. We can close an FHA loan as quick as a conventional loan, and doesn't make much of a difference at all. So, those are the main cons I can think of.
Yeah, absolutely. And I want to go back to must meet more strict property requirements. So when you're financing a home, you're not going to be able to purchase a home that's an investor special, a flip, the ones you see on TV, right? No, you're not going to be able to because there's too much risk involved for the bank to lend you that money because, again, you're going to need additional money outside of it to fix the home. So properties always need to, whenever you're financing, need to fit a certain requirement. Now, conventional tends to be a little bit more lax. FHA tends to be a little bit more strict. They tend to be especially more strict when it comes to condos and townhomes, specifically condos. Condos need to have something considered FHA approval. And usually the whole complex needs to be FHA approved, which a lot of complexes are not. So it's recommended to go the conventional route. Now you can do something considered a spot approval, which means you can approve one specific unit within the apartment complex. That's not, the whole apartment complex is not FHA approved, but the individual unit can be FHA approved. But again, that's a process. So when it comes to looking for townhomes or condos, we really do recommend going the conventional route just because it's a lot easier. Trust me, and a lot of realtors don't want to deal with the mess of having to figure out whether the property is FHA approved or not.
Good point, Anthony. That's very, very true.
Yeah. So, Angel, let's talk about who the FHA loan is ideal for.
Yeah, so many times it's for first-time home buyers, right? Like kind of we mentioned already. And those are for the first-time home buyers that don't necessarily have the best credit or don't have the most money saved up, right? So if you want to look at a conventional loan, I recommend it be in the 700s, preferably over 720. I mean, even 680 is fine in a sense, but over 720 is like where there's a big difference, I think, between conventional and FHA. Less of a down. I mean, you can do a 3% down conventional as well, but I like FHA a little bit more than a 3% down conventional. And it's also ideal for people who want to invest with as little as money as possible, right? And one thing I just want to touch on as to why it's so ideal for first-time home buyers and not someone who already owns a home is because when someone already owns a home, they're going to usually sell their home, right? And they're going to use that equity to purchase a new property, right? So they're going to come with a large down payment. Usually when you have a home, you're making your monthly payments every month, helps your credit's up. Homeowners tend to have higher credit scores than non-homeowners, right? So there's a lot to it, but that's what I think the FHA loan is ideally for.
Yeah, absolutely. And I really want to nail down people that don't have the best credit score and people who are struggling with that down payment. Especially when it comes to putting, 5, 10, 15% down. Like that's a lot of money for a lot of people. So be able to have that option to put 3.5% down is amazing, right? And me and Angel have always been a big fan. If you have the means to purchase and you can make that mortgage payment comfortably, the sooner the better. And for the last 10 years, since 2013, prices have only gone up year after year after year. So anybody that was able to purchase with the FHA loan with as little money down as soon as they had the means to has been rewarded handsomely or beautifully in the last couple of years, right?
Yeah.
So if you're able to get in, whatever means it takes, we just recommend doing it the sooner the better, and then let appreciation do its thing for you. And anybody who's been a property owner in the last year, you reap the rewards of, 10, 15, 20% year over year appreciation. We're talking hundreds of thousands of dollars in appreciation just the last 2 years. So, we're a big fan of just trying to get in as soon as possible. FHA loan might be the best way to do it for your first time.
Exactly. I think Anthony said that perfect, dude. I have clients that, I want to save 20 or I need to have more money. And it's like, the amount of money you're losing by saving, right? You're always trying to catch up to the new purchase prices. You're not letting equity, you're not letting your house build equity and make its money on its own. You don't have to do it. You just have to live there, right? You have your own house and you're building equity and you're making money off of it. And I think as a homeowner, it's not something we really think about. Like a lot of, our home's worth this much. But when you do think about it, it's honestly an amazing feeling to be like, wow, I bought my home for this much. Now I think if I were to sell it or if I were to refinance and it would appraise at this much, the amount of money that I've made over X amount of years, right, is worth every penny. And you don't have to have 20%, 10%. Just do it with what you have. And I think me and Anthony can both agree that we can promise you that it'll be worth it. We never had a client come to us and tell us, I regret buying a house. We've never had that.
Never.
And I've never heard that. So I think everyone loves to be a property owner, and the benefit of being a property owner is appreciation and equity that you get from it.
Yeah, absolutely. And there's a lot of ways to help you offset the payment. Like we mentioned before, you can purchase a duplex, and help you offset the payment there. Or a lot of people house hack, meaning they'll rent out individual rooms and then help them offset the payment that way. So there's a lot of ways to, lower that mortgage payment, make it more comfortable for you. But yeah, I mean, that's it, Angel. You nailed it. That was a really good podcast. I mean, what do you guys think, homies? Comment it in the description of this video for us. I really, really appreciate all your feedback and all your guidance. It really helps us out a lot. Exactly. Angel, where can we find you at?
At Your Mortgage Angel on Instagram.
At Your Mortgage Angel on Instagram. You know where to find us at the Luevanos Group. We're on every form of social media, whether that's TikTok, Instagram, LinkedIn, YouTube, podcast. We're on it. Follow us. With that said, I want to wish you all the best. Take care. Stay safe, y'all.
Thank you.
Hey, homies. It's Anthony. This podcast contains my opinions and is for educational purposes only. It does not guarantee any projections and should not serve as a basis for any purchase or sale in real estate.